Hello, this is Kevin from the Traders Investors Club. Today we're going to be looking at two bar patterns and how we can use them as a basis of a strategy to successfully trade the S&P 500 cash index. We're going to be looking at two specific patterns today, inside days and outside days. Let's start with inside days. An inside day is a bar where yesterday's high is lower than the high of the day before it. The low of yesterday's bar is higher than the low of the day before. In Japanese candlestick terms, this pattern is known as a harami, which is Japanese for pregnant. And as you can see, it nicely describes how the range of yesterday's bar fits within the range of the day before. Now here's a daily chart of the S&P, and there are three inside days here. I'm going to leave you for a few seconds to just see if you can spot them. First one is here. As you can see, the high of this bar is lower than the high of the bar preceding it, and the low of this bar is higher than the low of the previous bar. Likewise this bar, lower high and higher low. And finally this bar here, lower high, higher low. We're going to be discussing several strategies for trading the S&P 500 cash index. And although we're using the S&P daily chart to identify trade setups, the trades themselves are going to be intraday trades. And what I mean by that is that the entry is always going to be on the open of the cash session, and the exit is always going to be on the close of the cash session. Our strategies are going to consist of three elements. We're going to have a setup, a trade signal, and an exit signal. Now in the case of the first strategy, our setup requirement is that yesterday was an inside day. And as you may recall, an inside day is one where yesterday's high is lower than the high of the day before, and yesterday's low is higher than the low of the day before. Now for our signal, if today's open is greater than yesterday's high, we buy on the open. Conversely, if today's open is lower than yesterday's low, we sell on the open. In either case, we exit the trade on the close of the cash index. Now here's an example of what this trade looks like. Here you can see we've got an inside day, lower high, higher low. And once we identify this inside day, we can put two orders into the market. We can say if the high of tomorrow, if the open tomorrow is greater than the high of today, we want to go long the market. And if the open tomorrow is lower than the low of today's bar, we want to go short the market. Now in this particular case, we went long the market here. This trade worked out great. This would represent about 4 S&P points, which is the equivalent of about 40 Dow points. Not a bad trade. Unfortunately, they don't all work out like that. Now let's take a look at another example. Here's the one we've just looked at here, very nice. Here's another inside bar here, lower high, higher low. And the trade setup here is if tomorrow's open is greater than this high, we go long. And if tomorrow's open is lower than the low of this bar, we go short. Unfortunately, what's happened here is we've opened here, closed here, and that's a losing trade. Now this is not necessarily a bad thing, because let's just stop to have a word about trading strategies here. Any strategy you trade, you have to be sure that the probabilities are going to be on your side. You do that by backtesting, the sort of thing we're doing now, and you've got to be so confident in your strategy is you're going to take every signal that comes up. Now let's look at this strategy on the S&P 500. Now we're going to be looking at a period on the S&P 500 about 5.5 years. I've selected this because it represents all sorts of markets here. We've got a trend, a trading range market here. We're kind of sort of going sideways. We've got a nice bearish market here, and then a little bit of a bullish market. Now, so as you can see more clearly what the trades look like when they're placed, I'm going to zoom out and just really have 5 or 6 months of the S&P here on this chart. Now, the first thing I'm going to do is identify the inside days for you, and here they are with vertical grey lines. Now the strategy, as let me just remind you, we're looking for yesterday to be an inside day. If today's open is greater than yesterday's high, we're going to buy on the open today. If the open is less than yesterday's low, we're going to go short the market on the open. Now let's see what that looks like. Here we are. During this period, we've got 1, 2, 3, 4, 5 long trades. And they've all worked out pretty well, as you can see. Up here at the top, we've got what's known as the equity curve. And this is a graphical representation of how our trading pot is doing. And in this particular case, remember, we're actually backtesting 5.5 years, although we're only just looking here at the recent 6 months. Over that period, we had 19 trades with 13 winners and 6 losers, which is a win-loss ratio of 2 to 1, more or less, pretty good. Over that period, we've made 105 S&P points. Now let's refine our strategy a little bit. It's going to be basically the same setup. We need yesterday to be an inside day. We're also looking for the open to be greater than today's high for us to take a long trade. However, we're adding an extra criterion here, and we're only going to take the trade if the close of the inside bar is higher than the open. So really what we're looking for here is we're only going to take the trade if it's in the direction of the inside day. So hopefully we're going to get a little bit more momentum if we buy on a gap up where the day before has also been an up day. Conversely, if we'll only take a short today's open beneath yesterday's low if yesterday's close was less than the open, i.e. it's a down day. Right, back to our S&P chart. Let's see what that looks like. Right, well here we are, slightly fewer trades because remember we've added an extra criteria here, and out of the 17 trades we've got 11 winners and 6 losers. Compared to the very first strategy, which is here, as you can see, by adding that extra criterion, it really hasn't made too much difference considering that we're looking at a 5.5 year period. We've taken 2 less trades, and in fact we've missed out on 2 winning trades here. So the conclusion we can draw here is the direction of the inside day actually doesn't make any difference to this strategy. Now let me just spend a couple of minutes to talk about what's actually happening when we see an inside day. Well, what's happening is that the range of the inside day is smaller than the bar before it, as we've discussed. But what this is telling us really, as far as the trader psychology goes, is that the traders don't really know which way to go. We've effectively got a day of low volatility. And after low volatility, we're expecting the volatility to revert to normal again, and that's why we're looking to trade a gap. Now, let's take a different spin on the strategy. Our setup is the same. Yesterday was an inside day. Now, instead of looking for today's open to be higher than yesterday's high, we're only looking for the open to be higher than yesterday's close. Conversely, for a short trade, we're looking for today's open to be lower than yesterday's close. Now, effectively what we're doing here is we're going to trade every inside bar. We're either going to go long the next day or short the next day, depending upon where the open occurs. Okay, this is our S&P chart. Let's see what it looks like. As you can see, we've got many more trades than we had before because we've really loosened out the criteria for the trade. How have we done? Remember, looking back over 5.5 years, we've got a total of 126 trades, of which 80 were winners and 46 were losers. And once again, this isn't really too bad. This is, you know, a win-loss ratio of 2 to 1. And look at this equity curve here. It's nice and smooth relatively, just up until the last couple of trades here. But